Hey, everybody. Thanks for joining us. This is our last lecture of the quarter. So this is week 9 of the Sustainability Business and Entrepreneurship Lecture Series. I'm just going to make a few announcements and quick introductions as the rest of us sort of trickle in. We have Vicki Jovanovic here with us today, who I'll introduce in a moment. But first, I just wanted to point out that, as I said, this is the last lecture in the series. We are hoping to have all of these lectures up on YouTube within the next couple of weeks. So stay tuned for those if you missed any of them. If you'd like to watch one sooner, there's one that you're particularly interested in, just send me an email. My information is over here. So my name is Paige Archer. I'm the Assistant Director of the Celtic, which is the Center for Entrepreneurial Leadership and Transformational Change. We are a public service center here on the Olympia campus. And you can reach us at celtic@evergreen.edu. We host this lecture series every Friday during the fall, winter, and spring school year. And we also have a Sustainable Co-op Development Certificate and Transformative Leadership Certificate. We have some daytime course offerings, and we coordinate internships. We're currently in the process of matching students who want to do an internship in business management and entrepreneurship for spring. So if you're a current Evergreen student and you're interested in internships next quarter, please reach out to us. We have a few that are still available. Our co-sponsor is Thurston Green Business, which is a business designation you can get here in Thurston County. It's free and easy to apply, and you get a little decal for your business. So don't sleep on that. I think applications have closed for this year, but they reopen again every year, typically on January 1. Our fiscal sponsor is the Clean Energy Committee, which is a student-led committee with the mission to support clean energy projects and share sustainability strategies here at the Evergreen State College. And this lecture series is funded in full by the CEC. So thanks, Clean Energy Committee. Okay, Vicki Jovanovic, a financial advisor at Sawston Wealth Management, LLC, is focused on making finance accessible for Pacific Northwest residents. With a commitment to educating and simplifying financial complexities, she helps clients take charge of their finances and future. Vicki holds Series 65 securities registration and the AAMS designation, providing expert guidance for financial success. Her global background, spanning Asia, Europe, and the US, gives her a diverse perspective. Based in Olympia since 2012, she leads a balanced life, enjoying camping, hiking, Zumba, and diving into mystery novels, all while offering comprehensive financial advice. So, without further ado, I'll just stop sharing my screen and I'll turn it over to you, Vicki.
Perfect. Thank you. Thank you for having me. As we'll learn, investing in life is all about diversity. So we got to fit in all the fun things while also doing all the work. All right, I'm going to share my presentation. So today we're going to be talking about socially responsible investing and also these three letters ESG. There are some definite crossover between the two, but there's also some big differences. So we're going to just dive into what is it, how do we do it, and how can ESG, socially responsible investing, fit within just your regular investment plan, and what types of things can you do with that? Now, my name is Vicki Jovanovic. I'm just a local advisor. So anytime you have questions, I'm happy to answer them after the class. But if you have further questions, please send me an email, send me a text. I'm happy to meet you up in person. We can chat about stuff or set up a Zoom call. I really emphasize education. So I want you to understand your situation so you can make choices on your own rather than me just telling you what to do. All right. So here we are. There's me again. Woo. So my background, because I want to make a give you an example of how you can get into finance if that was something that you'd be interested in doing. So I'm actually a career changer. I've only been in finance for 3 years. Before that, I was an educator. So I taught both in Olympia and overseas for 10 years. I was an elementary music teacher and then decided I needed a change. So I got a job in finance, got all of my licenses, and there's a lot of crossover with what I do now. And teaching elementary music is all about education, making sure people are understanding the information, and helping people make really good decisions for themselves. So I have a bachelor's degree in education and a master's degree in education, and then a second master's in IT management. But actually, I didn't need any of that in order to become a financial advisor. What you do need is your various licenses and registrations. So if you're interested in becoming a financial advisor or a financial planner, which is a lot of what I do a lot of the planning side as well as advising. There's several things that you need to know that you enjoy. Being able to talk to people, being able to communicate with people and develop relationships with people is really important. When you think about finance, you often focus on numbers or you need to be a math person. And while that definitely helps if you feel comfortable with numbers and math, one of the biggest pieces is, can you connect with people? During any sort of financial planning, any sort of advising, you have to get your client's full story. And sometimes that is sad information. It could be embarrassing information. Maybe you're walking someone through a divorce. Maybe you're walking someone through losing their job. So really being able to connect with a client so that they feel comfortable talking to you, but also so that it's just a safe space for communication. And your clients might disagree with you, and that's okay. So having the ability to disagree while also explaining your viewpoint respectfully, that's really important. The minimum that you need to become a financial advisor is the Series 65. This is the test. You can take it through Washington State, or it's a national test depending on which level of firm you work for. It's just a multiple choice question or test, so there's not a lot of writing or anything like that. But this is the very, very first license that you need. There's other ones on the screen, such as the 7, 66, 63 that you can get as well if you'd like. The next level of certification is the Certified Financial Planner. This one is a bit bigger. You have to have a bachelor's degree in order to qualify for taking the education component. So after you have your bachelor's degree, there's like a 1-year education program that you have to go to that covers all of the topics that are in financial planning. And then there's a 6-hour exam that you'll take, as well as you have to sign a bunch of ethics paperwork and then have 6,000 hours of experience. Since I'm a career changer, I've done everything except finishing my 6,000 hours. I'm about 5,500. So by July, I will be able to have the certified financial planner. And it's just kind of the pinnacle of financial planning. And all financial planners are fiduciaries, so that's also really helpful as well. Okay, that is all I have about becoming a financial advisor. If you have any questions about any of that information, let me know at the end. I'm happy to answer anything. All right, sustainable investing. Is it possible, and how do I do it? I know it sounds like investing is all about making money. It's all about companies. And so we think about greed, or we think about driving profits. And that is definitely true. So it can be kind of tricky to say, okay, how can I invest, but still be in line with my values and making sure that I'm not supporting something that I disagree with. So it is possible, but there's some tricky things that you need to think about while you're doing it. So some types of sustainable investing out there, and these are a lot of the ones that we're going to be talking about today. I'm going to move my thing here. The first one is the ESG investing. So ESG investing is, oops, I'm clicking things. I shouldn't click things. It's a framework that, oh, now I made myself have closed captioning. I need to turn that off. There we go. It's a framework about measuring what a company does. So they have three different factors that they look at, and that's what makes up the acronym ESG. It's the E is environmental, S is social, and then G is governance. So we'll look at that one first. ESG is an investing strategy and a framework that considers non-financial factors along with traditional financial metrics. So they're trying to identify companies that are sustainable, ethical, and well managed, but they're looking at it from the perspective of, is this still going to be profitable? Because if you think about it, if a company is managed well, they're going to do pretty well. If a company is trying to make sure that they're stewarding their resources well, that's probably going to be a good thing for them because they're going to have more money to do other investments because they're not wasting their money. If they're trying to have good relationship with the earth, well, yes, it's great for environmental things, but it also might make sure that they have more renewable resources to run their company. So you see with ESG, it's less about the value and wanting to make a difference in the world, while it's more about looking at it from the framework of a company still wanting to make money and still wanting to have positive things for their shareholders. The other ones here are socially responsible investing. That's the one where you're more thinking of, okay, what are my values? Well, I really value green energy. So I'm going to make sure that I have investments that have no oil or no coal because that's very important to me. So you're planning your investments just around specific ethical guidelines. Impact investing is kind of a newer trend. So there's not a lot of detail on that. And not a lot of companies are doing impact investing, but you're kind of picking a specific goal and then positioning your investments around that one goal. And then green bonds. Bonds are loans that you give to companies, and then they have to pay them back with interest. So a green bond would be a loan that you're loaning for a specific project or a specific goal or criteria, and then they would pay you interest and then pay you the initial outlay back again once it matures. So ESG is environment, social, and governance. Environment looks at how a company's processes affect environmental stewardship. So like climate change, what's their carbon footprint? Pollution, what about renewable energy, waste management? So the environment side of things, they're going to be looking at that and seeing how can we make our company fit better in this world while still making money for our shareholders. S is social. So that's talking about your employee treatment. How are we managing the relationships with stakeholders? Now, stakeholders aren't just the people who are making money off of you. That's the people that you work for, the people who work for you, the people who are affected by your company, like maybe the community members around your company. All of those people have a stake in the company. So how are you developing those relationships? And that can be employee treatment, diversity and inclusion, human rights, community impact. Those are all in the social sphere of ESG. And then governance is the G, and it's how does a company's leadership and management affect the company as a whole. So looks at things like executive pay, board diversity, business ethics, anti-corruption policies. So thinking about ESG, all of these things are really good things. You want to have a company that's like, yes, we're going to be focused on climate change. We're going to treat our employees well. We're going to make sure our executive pay isn't exorbitant because we're not trying to nickel and dime everybody. But you can see how it gets really broad, and it can start getting confusing. So how it works is companies are then given a score between 1 and 5. 5 being the best. So if you have 5 globes, you're at the highest level of ESG reporting. And if you have, down to 1 or 0 globes, then you're not doing very well on ESG rating. So I have an example here. This is Natick's target retirement. Oh, I forgot a T there. Target retirement date 2030. The ticker is NSFFX. This is from Morningstar, and I can show you at the end how Morningstar works and how I could search for specific things that I want to invest in or things that I don't want to invest in. So as you can see here, it has the 5 globes. So this one is rated pretty high for ESG. You have a corporate sustainability score. You have a sovereign sustainability score, has a carbon risk. Notice it has a pretty low carbon risk, but there's no specific carbon designation. So they don't have it built into their business plan that we are going to be a low carbon fund. So that's something to pay attention to. The corporate sustainability score is an acid weighted average of the company level ESG risk rating. So they measure the degree to which a company's economic value is driven by ESG factors. The sovereign sustainability score is measuring the risk of the countries involved. So how are those countries known for ESG factors? Are those countries known for being really carbon friendly or anti-carbon? All these different factors. Then this is the same tickers. So you can see, oh, this guy, he has a lot of animal testing. So if that was really important to you, you would not want to choose this fund. But they use no fur and leather. They do have a high list on life ethics, and you can click into there to see what does that even mean. They have no investments in adult entertainment. They have very little GMOs. So this gives you a really great way to dig down into what does a company own? If I was to buy this, what would I actually be investing in? And here you can see they also have a breakdown of the fossil fuels and what is involved in that. So how they decide, especially in Morningstar, what rating to give a company, whether it's an individual stock or a mutual fund, is they break it down into all the different scores. So you have the corporate sustainability score, the sovereign sustainability score. What were they previously? What is it all together as a whole? And then how do those fit together into a composite score? And then that's where we get the 5 globes from. So when you're looking for investments that you want, you can, through Morningstar, and I'm sure through a bunch of other companies, I just talk about Morningstar a lot because it's the software that we use at my office. You can search for specific ESG restrictions. I'm looking specifically for I know I use coal a lot because it's on the top of everybody's mind. So I want to have no coal. And then you can look and it'll come up with a drop down of companies that you can choose from. And then you can dig down deeper from there. But ESG is not a perfect sustainable investing idea. So what isn't it. It's not the same as philanthropy. So it's not just like, okay, I want to be giving my money to these things, because ESG companies are still companies. So they're still running a company with the plan to make a profit. So they're not just like, oh, we want to make the world a better place. No, they're like, hey, we've noticed if we put more women in our boardroom, we're going to make more money. So we're going to put more women in the boardroom. It's not because, oh, we want to do that because of equality. So remembering that ESG is still part of the corporate world where they're focused on making money for their shareholders. And it's not just about avoiding bad companies. It A company that has things that you might disagree with may also have ESG ratings. That might be because they're not in an industry that you are interested in or that you care for. But remember, the ESG rating is kind of that global rating. So they might be doing pretty good in one area, but they're doing pretty bad over here, and this is the area that you care about. So you kind of have to dig deeper than just like, oh, it has a 5 score for ESG. It's a great company. Not necessarily. And it's not a guaranteed way to make money. So an ESG investment is an investment. So just like the stock market, as we've seen yesterday, today, the day before yesterday, can take a nosedive if there's ever any volatility, or depending what's happening in the political world at large, investments can go down. So don't only invest what you are willing to lose. That's always a good investment caution. So let's look at ESG versus some of the others. So you have ESG investing. Focus is sustainability and profitability. And it kind of takes those ESG factors and then puts them into a financial analysis to see what's going to be the best win for everybody involved. Socially responsible investing, the focus is ethics and values, and then you're actively avoiding certain industries. It's like taking it one step further than ESG. So, for example, you might buy or avoid buying a mutual fund that carries any sort of firearms manufacturers because you don't want to support any sort of firearms. That's fine. Or they might say, I want to invest in companies that only donate to charitable causes. You could find companies out there that donate to charitable causes. So socially responsible investing is much more focused. And then impact investing is kind of thematic investing, or focusing on creating a social good. So you're specifically looking for companies that have the goals to make social changes. Again, even more focused. So ESG is kind of the broad one. So here's some ESG investing strategies. So you can incorporate ESG factors into traditional financial analysis. You're like, you know what? I just want to dip my toe in this, and I don't want to jump full in with some of the socially responsible or impact investing. You can look at, what do I currently have in my retirement account? Do these funds have any sort of ESG ratings or not? Or if you're looking to buy something new, you could add that to some of your criteria. Exclusionary screening, you can screen away things that you don't want to be involved in, like tobacco, gambling. You can choose thematic investing, so looking like clean energy or diversity. An interesting way to do another way of ESG investing is called shareholder activism. And that's where, if you own a portion of a company, you actually have the right to vote for things like the board of directors. So if you get a large enough number of people to buy shares of a specific company, you can vote in a person that shares your views on the company into the board of directors, and then they can make changes from within the company. So we've seen a lot of people do that, sometimes towards things that we disagree with, sometimes towards things that we agree with, but it is a way to change a company. But here are some big pitfalls to watch out for. One of the biggest is greenwashing. So ESG, being sustainable, all of these things are really popular. So companies like to slap green on things to say, hey, we really are so sustainable, but actually they're not. Like, for example, there are several oil companies who have good ESG ratings, but they're oil companies. How is that even possible? Well, they are oil companies, but maybe they're doing things to offset. Maybe they're also investing in solar technology so that they can say, yeah, yes, we're fracking and doing all this stuff, but also we're developing new oil-free technology. And then that gives them their ESG rating. So you have to be willing to look a little bit deeper into the companies to make sure they really do stand for what they're saying they stand for. There's a lack of standardization. So there's not really a universal ESG rating system. It's not regulated by any sort of government system. So it makes comparing them difficult because maybe this is one company's system, this is the other company's system, but they're not the same. Performance trade-offs? Are there performance trade-offs? Now, sometimes it really actually doesn't depend on whether an asset is ESG or not. It depends on the asset class that is going to be the performance, the biggest performance driver. So really understanding what is this asset that I'm interested in buying? Is it a large cap fund? Is it a bond? Is it a certificate of deposit? Understanding what the asset is along with its ESG status is really important to make sure that you have a well-balanced portfolio and you know kind of what sort of risk you're getting into. But fees. Generally, ESG has higher expense ratios. So, because anytime anything is actively managed, that means the manager is putting in more time, then you're going to have to pay them for that. Here's some examples of some recent greenwashing. So, these are fines that companies had to pay for just not representing themselves appropriately. Like, for example, the third one down, DWS, it's a German mutual fund. They were marketing their ESG fund as greener than it actually was. And so they had to pay $25 million. Goldman and Sachs down at the bottom, they failed to follow ESG investment policies and misled their customers. So sometimes you might think you're doing or purchasing a green asset, but it's actually not. This is back to the lack of standardization. So sometimes it's hard to make things standard because there's different reporting needs and also there's different ESG metrics. So it's hard to follow like, well, which thing are we actually measuring? The framework is voluntary. So companies can use ESG language, they cannot. What level of language they're using is up to them. Geopolitical factors influence the acceptance of global standards. There's different acceptable standards of things in different countries. So not everybody's going to agree. And then, of course, lobbying efforts. So some of our big companies don't want to be pushed to the side because they're ESG or not ESG. And so they want to make sure that they get that sort of label, even though they might not qualify for it on their own. And then weak enforcement. There's no one following it, watching it. There's no one making anybody follow those rules. So it's just self-reported. And then are there performance trade-offs? Remember, you can't guarantee any investment. So really, it's all about making sure that you have a well-diversified portfolio rather than focusing on if ESG is better or worse. than um, non-ESG. So here's an example of this, and it is showing the difference between the S&P 500 index and then the just one ESG fund that also follows the same type of companies that the S&P follows, which is the large, big, massive companies in the US. So looking, we're pretty similar to each other, down, down, up, up. So really the performance in amongst similar asset classes is the same. Okay, so things to remember when you're wanting to jump in is that ESG investing is a framework to assess sustainability, but it's not one size fits all. So you can't just look at a company that has a 5 rating ESG and say, hey, this is going to be a really ethical company that's going to fit within my values and my plans. Not at all. You have to take a step deeper or maybe a couple of steps deeper to look at what's actually behind this rating and does it align with what's important to me. So doing your own research, looking beyond the label to make sure that what they're saying is truly authentic. And the great thing is that we're catching up. So this is all, green and sustainable investing. It's been in the works for a while, but it's only just recently started gaining steam. And so now people are realizing, oh, hey, we really do need to regulate this and standardize this so that consumers can more easily understand what they're investing in. So, how do we get started with investing? So, the first thing to do is define your priorities. So, what is the most important to you? Whether you're looking for ESG factors, are you looking to include or exclude certain industries, or looking for that socially responsible investing or impact investing, any of those kinds of things? Then you can research your options. Most often, you want to look into ESG mutual funds and ETFs. Those are going to give you, in general, they're going to give you a little bit more diversification, which often translates into a little bit lower risk as opposed to individual stocks. But if you're interested in individual stocks, you can do that. And you might consider project-specific impact-focused bonds. Then you need to evaluate the ESG ratings and metrics, and you can use things like MSCI, Sustainalytics, or Morningstar. So we use both Sustainalytics and Morningstar to look at what are the ratings for the companies and then drill down into what are the ratings and why are those the ratings. You can also read the company's own sustainability reports, but of course take those with a grain of salt because those are self-reported. But one nice thing is there are some third-party ESG analyses, so that can be really helpful. Choose an investment strategy. So you can look at integration, exclusions, thematic, and then monitor your portfolio. So these are all the same as you would regularly do with your investing. ESG is always changing. So you need to stay up to date with company policies and also laws. And then watch out for greenwashing and verify your company. Then make sure you're rebalancing about it's up to you. I would say maybe once a year or twice a year, you can rebalance your portfolio. I wouldn't do it too often. Otherwise, you just start tinkering. But all of this is not helpful if you're not ready to invest. Everything that we've talked about is about investing in the stock market, but don't invest in the stock market before you're ready. So there's several things that you need to look at to make sure, am I in a good place to be investing? So the first question is are you living below your means? So you need to have some margin in your life to invest. Otherwise, you're going to be running into debt. So do you have any current outstanding debt? If you have high interest rate debt, I always recommend that you pay that off first before starting any investments. Because in your investments, you're going to make what, 5, 6, 7%, probably, or maybe higher, but you don't know. As you raise the amount that you're hoping to return, you also raise your risk. So that means that you might have a portfolio that's really up and down. So if you have a credit card that's 29%, well, you're going to be losing money by putting it in a 10% fund. You have a 20% basic difference there. So you need to make sure that you have a handle on your debt before you start investing. Another thing you need to make sure is, do you have an adequate emergency fund? If you were to lose your job right now, would you have 3 to 6 months of living expenses saved that you could tap into to make sure that you can cover your bills for that period of time? So we always recommend making sure that you have that emergency fund before starting to invest. And then have you outlined your goals and your timeline for your investments? No investment is the same, and no investment strategy is the right strategy. It's completely personalized to your specific situation. So if you're saving for a trip to the Bahamas in 5 years, that's going to be a completely different strategy than if you're saving for your child's college in 10 years or even your own retirement in 30 years. Those strategies are going to be very, very different in what you buy, what type of account you open, the level of risk you take. So you need to decide ahead of time, why are you investing, so that you can make those good decisions. And then, do you know which type of account is appropriate for your goals? Each different account has specific pros and cons. They all have different tax treatments, different purposes. So you can't just open one account and be like, hey, I'm going to put all of my investing money into this one account. Each one has kind of different purposes. And so you want to make sure that you're choosing the right one for what you need. So when you're ready, this is what you're going to do. You're going to open an account. You've already chosen which one you're doing. You're going to contribute money to that account, but now it's just cash in there. So you can't just let it sit. You have to buy assets. So whatever you want, whether it's some ESG funds or bonds or anything like that, and then monitor them. Pay attention. So that's the 4 steps for investing. And you can buy all sorts of stuff. A stock is a share or an piece of ownership of a specific company. So if you wanted to own Microsoft or any company, you can buy a stock and now you're an owner. You can then vote in that company. A bond is a loan that you give the company. They have to pay that money back, and they pay it back with interest. A mutual fund is in my perspective, is my favorite kind of asset, or a mutual fund or an exchange traded fund. It's the same concept where it's one big pie and this company owns a piece of maybe 1,000 different companies. And then when you buy one little piece of this mutual fund, now you own 1,000 companies as well. What if one of those companies went bankrupt? Well, you'd be fine because you still own 999 other companies. So you can see how owning a mutual fund might lower risk just a little bit. And then CDs, certificates of deposit, they're FDIC insured loans to banks. But there's a ton of other things that you could buy. These are just kind of the most common. And then, like with all of life, diversifying is key. I know we're having some struggles in our country this few months and these couple of years with people having a problem with diversity. And actually, I think a lot of us know that life is much better when life is diverse. Diet, people, experiences. Life is just richer and better when we have a diverse experience. And it's the same with investing. If we're invested in one single thing and that one single thing has a bad month, our entire portfolio is ruined, right? But if we have all different types of assets from different sectors mixed in to make a wonderful, diverse portfolio, then we're protecting ourselves. Because if this asset goes down, this one goes up, we're still fine. So you can skew your portfolio more aggressive, more conservative, depending on the different types and the different proportions of assets that you own and that you buy within your account. But it's so important to make sure that your account is well diversified. Then here, this is just a picture to look at why you would want to have a diversified account. Each column is a year, and each color is a different asset type. So you can see here, large cap does tend to stay near the top of how much it's earning. Ooh, during 2022, large cap jumped way down here. But if you look at real estate did real bad in 2022, 2020, but real estate in 2014 was the best performing asset, and in 2012 and in 2006. So if you were just to have all of your money in a high yield, you'd kind of be all over the place. But if you were to have your money spread out a little bit in all of these categories, as one goes up, the other goes slightly down, and you're going to have a lot smoother of a ride rather than this crazy wave where things are just out of control. So this is a really great, I love looking at this picture. I think it's a good reminder of why we need diversity, both in just our personal lives and in our investments. Well, that's all I have for you about this topic right now. But again, please, I'm so happy to answer any questions, whether it's on about what we talked about, or if you have personal questions about your own portfolio. I'm happy to talk with you in a more private situation. You don't have to ask any personal questions right now. But if you have any questions about the presentation as well, I'm very happy to answer anything.
Thank you so much, Vicki.
Yeah, great question. So companies don't necessarily want you to know. So they're not going to have it on their front page of their website. But you can look at their annual filings. So every company has to submit every year an audit of their finances, and you'll find those on their company website if you dig down, and then also a website called Edgar. And they have all of the government filings, so you can see who did they give money to last year and the breakdown, because they have to include it in their chart of accounts. So it shows where money went. Okay, this is an excellent question. And I wish that we had a crystal ball to be able to say, hey, this is what's going to happen, but we don't. So goes back to goals. Now, I have investments. I'm in my mid-30s, so I have investments for my retirement. I'm currently not changing any of my investments that are for my retirement because my goal is still 20 years down the road. So I have a long time for my investments to recover. So I've covered my bases by being invested in companies that I feel confident in. I have looked at, okay, do I have investments that are currently being run by crazy people? No, so that's good. So I'm kind of taking some steps to protect myself, but at the same time, I'm not worried about it because I'm looking a long time in the future. Now let's relook at, I also have 2 children who are getting closer to college. Their accounts, because their goal is a lot shorter, we are making changes in their investments to be a little bit less risky, because right now we don't have quite as long to try and build back our investments after this volatility. We don't know where it's going to go. The Fed was already in place to lower interest rates again this year before 2025 started. And as of now, we're looking at possibly having a rate increase by the end of the year, depending on what happens. So if you had a short-term goal, I would recommend do not be in the market. Put your money in a high yield savings account or anything like that, but do not be invested in stocks, bonds, mutual funds, anything like that. So yes, volatility is crazy right now. Not off the top of my head. I hate to toot my own horn, but we are a women-owned and run firm. There's just two of us, and we're both women. So if that's is special to you, you can come work with us. But as for companies and different investment firms, not particularly. You just kind of have to dig and look at the ones that you're interested in and see what you think. So anytime you're looking at alternatives, they can be a great idea. They carry a lot more risk. With them being alternatives, so anytime any asset trades on just a regular exchange, they're going to be highly liquid. So if you buy a mutual fund, if you buy a stock, anything like that, you can sell it the next day because they're traded very easily every day. Sometimes you get in a position with alternative investments, like you can buy real estate, you can buy derivatives, commodities. There's a lot of other things that you can be involved in. They get a lot more complex, which means there's more risk. You really need to make sure you understand each of those instruments really well, because otherwise you can kind of dig yourself into a hole. And then a lot of them have more stipulations. Like we have a client right now that she owns an asset that only has one sell date a year. Well, right now that's not good. And so she can't sell out of this thing that she wants to because she literally only has one sell date each year. A great idea or a great question. Just asking local people can give you a good feel about, hey, how is this person in my community? But if you want to know, like, have they been reported? You can go to the SEC website and also broker check and type in their name, or if you know their number, all of us, we get a number. You can type in that, or you can search by city and zip code and see who pops up, and you can check, you can look at their licenses, if they've had any complaints against them, how many companies they've worked at, but it doesn't give you the like flavor of, oh, I really liked working with this person, or their fiduciary versus suitability. It just tells you like, has this person broken the law? Has this person lost a license? So it's a good thing to check while also getting like word of mouth or recommendations from just your local area. Also, always ask if their fiduciary status versus suitability status. Fiduciary means that we have to put the client's benefit above everything else, versus the suitability standard means if you were to buy this asset and or this asset. This one, they both make the client the same amount of money, but this one gets you more money. You can choose this one. Fiduciary, you can't. So like we don't make any commission at our office. It's just being part of that fiduciary. This is really hard because most investing is with publicly traded companies, and most small businesses aren't publicly traded. So they're going to be, private companies, privately owned. And so one thing you can do is, I mean, if you wanted to really, really grow, you could have an IPO and an initial public offering and become a publicly traded company. Or you just work with things like the Chamber of Commerce, getting the green the green certification that they're doing. That way it's a local thing, and people who are looking for local green companies, we can look for those are the companies we want to shop at because they're making the difference. You could do something like uh offering employee ownership things, but really it's hard for small businesses because mostly they're private companies rather than publicly traded companies. That is an excellent question. And again, it's that full picture diversification. So there is not one company at all that I would say, hey, this is a great buy. Not even slightly, because you want to have a little piece of all these different things. So making sure that your portfolio has, so here are the different, okay, I'm digressing. So large cap companies are all companies that have income of over $10 billion a year. Mid cap are 2 to 10 billion. Small cap are underneath 2 billion. So think about the small companies. They're still making $2 billion a year. They're not really small companies. But that, when you're looking at the US and world stock market, those are kind of the breakdowns. So you want to make sure you have both small, middle, and large. You want to make sure that you have international while also having bonds at the same time. So you kind of have a wide array of a ton of different assets. There are positions that you can buy that are just total stock market. So it'll take a cross section of like the entire stock market and bundle it into one mutual fund. So you could purchase something like that. So that way it's well diversified. But right now, there's no crystal ball as to what's going to happen, which departments are going to be taken away, what's happening with the stock market. It's all about is your timeline going to be long enough and are you well diversified? You can also think about whenever there's a stock market crash, it's really bad for people who are already invested, but it's kind of like the stock market is on sale. So if you have money that you've been waiting to invest in a down year, it's actually kind of a good idea to try and buy something because it's on sale. You're going to get it for cheaper than you would if you had bought it in December. Of course, making sure that the investments are in line with your goals and with your timeline, and that you're not investing more than you can safely invest, thinking about your emergency fund and things like that. Where can we learn more about sustainable investing after this lecture? Morningstar has a lot of different seminars that you can look at and watch. Those are really great. I'll think about some other things and I can maybe send an email with some different resources that you can look at. What's my next move? Or is there something that I'm looking forward to doing in the near future? Well, I'm almost done with my CFP hours, so that's very exciting. And nope, I just like where I'm at. I love my company. Absolutely not. Nope, every little bit counts. And as your balance grows, the compound interest will make it grow faster. But nope, getting started right now with what you have is perfect. Yeah, no, that's a great question because AI is coming in everywhere. So in our personal firm, we don't use AI, except we do use it in a couple of different situations for some of our marketing and like social media posts. We'll use AI for that. But we come into an issue with regulations and regulating. We always have to know why we are recommending something and also looking deep into the data because ChatGPT, AI, so far, it's not foolproof accurate. So if we were to type something in and request something, and then it spat out, okay, here's a financial plan, or here's the assets that you should buy, and then we do that, and it turns out that it was not correct, that would be really, really bad. So we have to be noting why we're recommending something, why we're choosing to not recommend something else, the pros and cons, and the data behind it. So for us, it doesn't really make sense to be using AI yet. But I know that there are several software companies who are working on developing financial approved and SEC approved technology that would use AI to kind of help with some of the side things. Um, but yeah, so we're kind of dipping in slowly while also making sure that we're not breaking any laws. It's a highly regulated industry. Not necessarily. Penny stocks are I can't tell you if they're a good or bad decision because it really is luck and down to timing luck. So it's hard to say, hey, do this because you're going to get a consistent return. I'm really vanilla, plain Jane. You can invest with a very low amount of money. I mean, there's apps that you can do like, okay, I'm going to put $10 in every week or whatever. So you really are investing with a small amount. But trying to get like, GameStop, all of those things, trying to get into these penny stocks where you're going to be able to make a lot of money, you have to watch it. You have to be really on top because the stock could drop in 10 minutes and you were doing something else, not staring at your phone, and you missed it. So I don't recommend people do that unless that's their job and they know really the ins and outs and the consequences of their actions. I would say it's a much better, sustainable, long-term plan to just invest a little bit at a time when you can for the long haul. It's kind of the boring answer, though. I'm sorry.
Awesome. Well, I know that we're 2 minutes after two, so I want to respect your time. Vicki, thank you so much for
You're
joining us.
welcome.
Just like the last time you were with us for this series, there's so much information that you included, and so I'm really glad that we record these so that we can go back
Yes.
watch it over and over again. If I can invite everyone who's here in the audience just to put in the chat or use emojis, just to show our gratitude for your time and your expertise today. Thank you.
Anytime. And again, if you guys have questions, please reach out. I'm happy to chat.
Awesome. Thank you so, so much.